Hey, how's everybody doing?
Good.
We're good. We just finished our weekly check-in with each other, so they all kind of just touch base with what they've been doing to reach their goals and what they plan on doing in the next week to reach their goals. And I did have a chance, Tim, to just kind of briefly tell them kind of who you are and what you do, and a little bit about next gen personal finance. So, but I think you could explain it probably a lot better than me. So by all means, you can address that when I turn it over to you. So Tim, thanks for being on the call with us. I think I told you that this is a group of young people. They're all about 15 to 20 years old, right in there. They all are very, very interested in their financial lives, their financial future. It is, as you know, I teach personal finance, and this group that I see right here would be like my perfect class. If they were all in my classroom on a daily basis, eager to learn about money and investing, that would be a dream come true. I mean, most of my students are pretty interested, but this is like the top 1% of the young people out there that I've come across who are actually wanting to be intentional about their money now and in the future. The other thing they all have in common is they're all very interested in real estate investing, and starting to do that at a young age. Some of them, even within the next year. Those who are maybe more in the 15 years old end of the spectrum, maybe not for another 4 or 5 years. But so they're all really interested in money and personal finance and earning and saving and investing. And so I think that's why having you on will be a great fit, as well as some of what you've done from an entrepreneurial standpoint, because many of these young people are, if they're not entrepreneurs already, they are definitely considering that in one way or another. So I kind of just, in my head, Tim, I'm thinking you can chat with him for as long as you want to start us off here. And then we'll definitely try to have some time for question and answers at the end. And we'll just kind of see how it goes.
All right. Thanks, Dan. And you guys should fill up the chat too with questions as we go. Anything that catches your attention that you want to know more about. A quick real estate story for you. So I moved to California in 1992. In 1995, I was renting a small cottage behind someone's house. And it turned out this was a fella who had taken an interest in real estate at a very young age. So this is Northern California, kind of a hot real estate market. Starting at the age of 18, I think when I got to know him, he was close to 40. He had parlayed, and he was somebody who was very handy too. So he'd buy fixer-uppers and he'd flip them. And over the course of, again, I think he was about 40 years old, he had probably, I don't know, turned a small amount of equity into quite a bit, millions of dollars. And kind of that's, when it comes to real estate, it is all about, location, location, location. And he just parlayed, a starter home, flipped it, made tens of thousands of dollars, bought another house. And obviously they had the good fortune of Northern California, outside San Francisco being an incredibly hot market. So that's my real estate story. Just a little bit about me. I was the fifth child in a family of 6 kids. Neither one of my parents went to college. My dad was actually from England, and he just through hard work kind of started as a bank teller and retired 43 years later as a senior vice president, and kind of great role model in terms of work ethic. But because I came from a family of 6, and I was the 5th child, it was clear to me if I wanted to go to college, I had to pay my way. Like I was going to have to earn a good part of that. So I started working at 12, kind of got a paper out, then spent 8 years as a golf caddy. And by the time I was ready for college, I had $20,000 in the bank, and I was able to graduate, pretty much paid 75%. Now, the problem was that was 30 years ago, and school was a lot cheaper. And so I can't say that to you now, oh, you should just work and you can kind of work your way through school, because college costs have risen a lot faster. I think the college I went to was 5 times more expensive. I went to University of Virginia. So it's kind of a different ball game. But clearly my parents, even though neither went to college, education was key. And so I got the job out of college. Yeah, I would have not, again, I didn't know what I didn't know, but I got in terms of a launching pad for my career, my first job out of college was as a business consultant. So we went into companies, and it was a great education in corporate America, because I was there for 3 years and probably went on 30 different assignments, everything from helping General Motors figure out their CapEx strategy to, manufacturing, kind of working in manufacturing plants. It just a phenomenal experience, had a great mentor there. And that kind of got me started. I think you guys, this is awesome that you all have found a group that's one thing I never really had, was a group of folks, you're entrepreneurial, you're interested in real estate, you can kind of kick ideas around, and hats off to Dan for kind of organizing this group, because this is so valuable for you all to have a community that can talk about a common interest in both real estate as well as your own personal finances. Because I didn't really think about entrepreneurship. I got my master's in business administration, and I was going to be work at a mutual fund company, and that's the job I got out of business school, where I was an investor. So my job was to go out and do research on public companies, and then come back, and the portfolio managers, the people who ran those mutual funds. And so those of you not familiar, a mutual fund, all it is it's an investment where instead of owning one company, the manager of that mutual fund may invest in 100 companies. And so the advantage being something called diversification. And so my job was to do all the grunt work, kind of create these spreadsheets and figure out what was a good investment. So I loved investing, but I hated the job. And so after a year, and this was a great job. I mean, it was like, this was a job that I could see myself in 20, 25 years being very comfortable. So it was really, it was a big risk on my part to say, what, I don't love this job. And I think, if there's another thing I learned from my dad, it's love your work, because you're going to spend 40 years doing it, 40 hours a week or probably more. Like, really find something you enjoy, because guess what? You're not going to be good at something if you're dreading Monday morning. You're like, oh, I got to get up and go through, and I got a terrible boss, and I'm not really into the business, and I'm not really that excited. Again, I've had the good fortune. I can't, with the exception of that job in the investment world, I've always felt energized. I've always thought about the work that I'm doing, not just while I'm at work, but outside of it. And I think that's part of entrepreneurship, is it's, a desire. You don't see it as a job. You really see it as, if you're really tied into the mission of the organization, it's a lot more. It's kind of, it's something that's bigger than yourself. So anyway, I was involved in a couple of entrepreneurial ventures. One of them, was a, I kind of laugh about it now, it was a paper shredding business. Those trucks that you see going around cities that have those large, they're either collecting the material and shredding it at a facility, or they're shredding it in a big truck. And that's basically protecting company information. So if you're a healthcare company, if you're a bank, you have to protect your, so that was the job I took coming out of, after I quit at the investment management firm. And that was, our timing was perfect. What we did was we created a nationwide company. We acquired basically 24 acquisitions we did, so that we knit together a national company. So the large banks at the time, Wells Fargo, Bank of America, they were our accounts. And so that was a big change in the industry, because at that point there weren't many national players. And so we helped, the word is consolidation. So we kind of created a national brand and then sold the company. And then the second business I was involved in was a data business, where we sold information to corporations. The specific information was around executive pay. So when you're a large company, you have to have a method as to how you determine how you're going to pay the CEO, the CFO, the people at the top of the organization. So we created a nice database. Again, it was kind of novel at the time. It was a new, it was something that nobody else was really doing. And so again, as a startup, if you're interested in startups, what you discover is, and most people won't tell you this, the most valuable skill you can have is not financial skill, and it's not operations. It comes down to sales. Like, you better be able to sell, because when you're starting a company, you are selling to new employees. Why would I want to join your company? There's like 5 of you on the team. How do I know there's really something here? So you have to convince folks that you're competent and that you're inspiring and that you're going to be successful. You got to sell customers. If you got a new service, you got to convince people that, hey, you've never used this before, but you should. It's going to make your life better. So you quickly learn that's important. You got to sell investors. If you're going to start a company, you're probably going to raise, at some point, you may need to raise money from outside folks, from outside investors. So you have to sell. And I've never thought of it as selling. For me, it's pretty natural when you believe in something that the message gets across to people, and they're like, I want to jump. I want to be on this team. I want to be a winner. I want to win. Like, that's kind of my background's always been. And it started at a young age because I was an athlete growing up, baseball and basketball player. I loved competition. And when you get into business, it's no different. I like winning, and I like to put together teams that win. I guess the other, let me take this question from Bryant. I think, again, I don't know my sense when it comes to education is that it's really important. Now, I also know education is really expensive too. So what I always tell folks is kind of find a lower cost way to get an education. And the reason I say that is it comes down to not putting all your eggs in one basket. Like, let's say we're in the middle of a pandemic. Let's say this thing stretches out for a longer period of time than people anticipate. And nobody knows, right? Anybody who says, oh no, economy's going to come back, everything's going to be normal. We haven't had this situation before, folks. Actually, there's a great book to read. If you want to read, I always think history is really important to understand. It's called The Great Pandemic, and it talks about it's written by a guy named John Barry, who's a professor down in New Orleans at Tulane. So, and you'll see, if you look him up, you'll see he's done a bunch of podcasts, but he wrote about what happened in 1918. And I read the book about 6 months ago, and we are pretty much following a very similar track to what happened in 1918. Now, the Spanish influenza, the Spanish flu, was a lot more deadly. People were just dying in the streets. It was horrible, but the politicians weren't addressing the issue at all. And there was a second wave. And the reason there's a second wave, had nothing to do with the virus. I think it has to do with human psychology. We get tired. Like, we get tired of being apart from each other. Like, our natural inclination is, I want to be around people. And it's been 9 months. I can't do this anymore. And that's what happened. That's what happened in 1918. There was a first wave, and everyone's like, oh, it's not that bad, see? And then all of a sudden, boom, second wave, and it was the same. The first wave was in the spring, the second wave was in the winter. And that's kind of, so I always think history, it's important to read history because it doesn't exactly repeat itself, but it's pretty close. And what you realize is that psychology, human psychology, having lived through this pandemic, I saw some heads nodding when I said, it's hard 9 months in, 8 months in to still be sheltering. So I always think education, like you can learn stuff too. If you have a focus, you're like, I'm really interested in real estate. Well, go find a school. Could be a community college, could be a 4-year college, but study real estate if that's what you're really interested in, because it's going to do a couple things. Number one, you're going to meet some professors. Guess what? Professors can be really helpful after you graduate, because if they're a real estate professor, they're going to be somebody you're not just going to benefit from them teaching you, but perhaps afterwards too, because most professors have side hustles. If you teach real estate, you also probably are an investor in real estate too. You're going to learn a ton. Second thing you're going to build is a network. Everybody in your real estate class probably has an interest in real estate. You may find a future business partner there. Now, the key is that you don't saddle yourself with too much student debt, because the minute you graduate with too much student debt, your options are limited. Got to make money. I got to start paying back my student debt. I may choose a job because it's going to pay more, even though I don't really love it. And so you want to be really cautious about you want education, but you want to get it as affordable as possible. There's a rule of thumb that says you shouldn't borrow more than what your expected starting salary is. So the problem is many people change their majors. I started out as an engineer. I graduated with a business degree. So you often change your major, but you just want to plan out. If you're going to go to a 4-year school, you want to plan that out before you go. So okay, I'm not just planning 1 year at a time and trying to figure out how I'm going to bootstrap it, but I'm looking at the long term and saying, okay, I'm going to graduate and I'm going to have, less than $20,000, $30,000, $40,000, because you just don't want to get caught. There's too many stories of folks. I didn't realize, how did this happen? You want to plan. You want to plan ahead of time. So I'm all about education. Can you get I guess the last point about education is, you may at some point as a real estate, you may want to go raise money from investors. And investors are really picky when it comes to something called pedigree, which is, where'd you go to school? And that's just, unfortunately, good, bad, whether it's right or wrong, it doesn't matter. Like, that's what they look at. Where'd you go to school? What's your degree in? So I think it's harder for you to go out and raise money or convince people to give you money to invest in real estate. And ultimately, especially if you're young and you don't have a lot of money to play with, then that's probably the path you're going to go down. So yeah, that's my bit. I don't have high hopes that the government's going to address. I wouldn't count on the government addressing student loan debt. I think it's, there's been talk about loan forgiveness, and I think that's a tough one. That's a tough one for them to pass, right? Because can you imagine being the person who graduated $50,000 in student debt and just made your last payment? You paid it all back, and then all of a sudden you heard about this student loan forgiveness. Yeah, I don't. So I wouldn't count on that. Like, they had this student loan forgiveness program where if you work for a nonprofit, if you're a teacher for a 10-year period and you make on-time payments of your student debt over that 10-year period, it'll get forgiven. I want to say, last I checked, like, tens of thousands of people had applied for loan forgiveness and like less than 200 had gotten it. The government just does not design systems to help people, unfortunately. And I remember when that loan forgiveness program was set up, I wrote a blog post saying this is going to be a disaster, because you had to jump through about 20 hoops in order to get that loan.
I'm one of the people who applied for that, because I am a teacher. I had been doing it for 10 years and I had made on-time payments, and I still had a chunk of money left that I owed, and I did not get accepted, and I didn't get any help. I wasn't really expecting it, but it was worth a try, I guess.
Yeah, it was incredible, kind of the hoops they made you jump through. And it just led me to believe they really didn't. They wanted to make the promise of student loan forgiveness without really delivering. Let me see some other questions here. You want to buy an investment property, what financial position should you be in? Yeah, that's a great question. Now, obviously, you're probably, because Dan's giving you great advice here, you're creating these spreadsheet models to figure out, okay, when is this thing going to cash flow? I think you want to have an emergency fund set up, and I think you probably talked about emergency funds, I assume, so that you're not entirely reliant on the income of this investment. And I think there's a really interesting, I don't know if you guys have talked about it, like, as I was thinking about this conversation I was going to have tonight, like, there could be, I would bet on it, as a result of this pandemic, there's going to be an exodus out of New York, San Francisco, out of these high cost cities, into secondary markets. Austin's going to be incredibly hot, Austin, Texas. Because what's happening is these tech companies are saying, guess what? You don't have to show up in the office anymore. You can work. And geez, you know how much it costs to rent an apartment in San Francisco? Like if I could go live in Columbus, Ohio, because I went to Ohio State, or if I could live in New Orleans because I went to Tulane, like I really think a lot of secondary markets, and again, with real estate, it's location, location, location. Like you want to be in a market that's growing. And I think you're going to see, secondary towns, secondary cities that have strong universities, because ultimately it's all about, it's all about kind of this ecosystem of, you want to have graduates who are staying in the area, starting businesses. And so I think if, these large, if you're in the Midwest, it's the Ohio States, probably South Bend, Indiana, Madison, Wisconsin. In Denver, I think obviously there's a lot of great universities in Denver. I really think these secondary markets, that's the play in real estate is because, I'm already starting to see it in San Francisco. We just had somebody on our team move back to Australia because, part of it is the real estate. Like she had no hope of buying. She and her husband just had a child. They had no hope of buying a home because, the minimum cost on the peninsula, south of San Francisco, the average home is probably 1.2 million. And it's, you'd walk into the house and you'd say, really? 1 point. So I think there's going to be tremendous. If somebody were to say, hey, what do you think the real estate opportunity is? Number one, avoid retail at all costs. Like bricks and mortar retail is dead. Warehouse is probably going to do well because Amazon and Walmart are all going to plant these warehouses as close to major metro areas as possible. But I think for residential, for, multifamily, I really think it's looking around the country and figuring out where are the folks from San Francisco, where are the folks from New York, where are the LA, where are these high price markets, where are these people going to go to? Boulder's probably another one, Boulder, Colorado. They've got the University of Colorado there. So that's my play on real estate. I have not, just to be full disclosure here, I've never invested in in a real estate property other than the homes that I live in. So I can't speak from, exactly what financial position you should be in. I just think you don't want to be, again, this idea of diversification, not having all your eggs in one basket. You want to have money on the side if this thing doesn't cash flow the way you expect, right? Because you don't want to be one rental payment. Oh, no, somebody lost their job and now they're not making the rent payment and now I'm in trouble. I'm assuming, Dan, you're spending a lot of time talking about cash flow.
Yeah, we talk about a lot of those things. Yep. Yeah. An emergency fund, like you mentioned. And I'll just point out that you should have an emergency fund for your life, for your personal finances, but then you should have an emergency fund for every property that you own as well, which I think we've talked about before too.
Yep. Yeah. So the question about why I don't invest in real estate, it's, so let's kind of step back for a minute here and just talk about investing in general. So what I have done over my lifetime, and it's kind of, I've made a lot of mistakes along the way, so I can tell you all about them. I think there's a life cycle for investors where when you're in your 20s, you want to invest in individual companies. You're like, I'm going to find the next Apple. I'm going to find the next Netflix. Like Tesla, you look at how Tesla's been doing. And actually, how many of you, raise your hand if any of you invest on Robinhood, on the Robinhood platform? Any Robinhood investors? Okay, I see 2. All right, tell me, if you guys want to talk a little bit about your experience, I'd love to hear it.
I just kind of did it a little bit with my dad. So I'm only 16 years old, so I had to do it kind of through him. I haven't done much of it. I've probably only thrown 200, maybe 250 in, and don't do as much anymore. But yeah, like I just kind of did it through his account. So,
which companies?
I think about it was mostly index fund. We bought this one. It was like a small startup we kind of believed in called Genius. It's Genius Brands. And then also some AMD stock, like before it blew up. So that was a good investment.
I'm sorry, you said AMD, the chip maker?
Yeah. Advanced Micro Devices. Yeah. So, and I think those are the only ones. I really haven't dipped my toes in very, very far, but yeah.
Cool. Thanks, Leo. How about you, Ethan?
You flipped it a little bit. I'm Leo, but I've been doing it for about a year. I'm 17, so I've been doing it with my mom. But I put about $3,000 into it, and I kind of just used it as a learning curve. Just use this amount of money that I saved up to just learn, which wasn't the smartest decision. But I just looked up the companies that I liked first, and then I wrote them all out, wrote how much they were currently, and then did a little bit of research on where I think it will be in the next 3 months. And then I just started putting my money in the companies that I believed in. I started with my own interest first, like Nike, and then Apple and the big companies. So I bought like one of each of there, spent like $1,000 putting it there, which those are the only green ones I have right now. And then I started watching YouTube videos, which I don't think is a good idea for me, seeing other people's opinions on it. And they started telling me like, oh, you got to put it into penny stocks right away, do a little bit of research and just put it there. And then I started reading the hype, which was in these apps, Webull and Robinhood, they have comment sections. And this is the worst place to get your information. And I would just look through the comments, and they would basically say, oh, put your money here. Oh, look, it's about to go up in the next 2 days. And I would be like, okay, I put all my money there. And the next day it's opposite of what they said, drops down. And then I'll read the comments again, see what it says. So I would really buy into the hype and put my money wherever the hype is. But I lost like $1,000 on that. So it's $1,000 lesson for me, which is way better than losing $20,000 on a bet. So I really learned to do my own research and stay away from the hype. And I started putting my money into index funds. And then me and my mom invested a lot into Tesla recently. So that's been my experience.
Wow. You know what? I want to thank you for sharing those lessons. I hope everybody listened to that, because like you said, that $1,000, that was the best lesson you could have ever learned. So if you go to YouTube and you search penny stock strategies, you will find videos with millions of views. And the promise here is that, hey, you can buy a stock for only 7 cents and it will double or triple. So here's the deal. Does it happen? Yes. Does it happen a lot? No. Is there an incredible amount of manipulation in those markets? Yes. The person putting that on the video, trying to feed the hype, probably bought it at 2 cents. They're getting people to buy in, so the price goes up, and then it's called pump and dump schemes. So before you decide to go into penny stocks, do a Google search, penny stock fraud, and you will find dozens and dozens of cases. But I just thank you for sharing that, because that's incredibly valuable. And you've done the life cycle. I talk about the life cycle of investing. So the first stock I ever invested in, it could have just as well been a penny stock. I took my first paycheck, half of it, and I bought $700 of a company called Check Robot, and they were going to automate checkout counter. So you go to the supermarket, right? Instead of having somebody put you through, now this happens today. This was 30 years ago. I was a little bit early. That stock went from 7 to 2, and that was a good lesson. The key is that we learn from these things. We say, you know what, maybe that was a little speculative. So what I tell people about investing, the faster you can get to index funds, the better off you are. So here's what an index fund is. Instead of picking an individual stock, you buy the stock market. So there are these funds called the S&P 500. That stands for Standard & Poor's 500. It's 500 of the largest companies in the US. In fact, I will share with you, I think there is a great visual for this. And I know, a couple of folks mentioned index funds. So I want to kind of help you visualize exactly what that is. So I'm going to put something in the chat, and I'm going to ask you to click on it. Okay, here we go. Click on that. Okay, so when we say index funds, what you're looking at is what's called the S&P 500. 500 of the largest companies in the US. So you probably see, and the size of the box refers to the overall stock market value of the company. So you probably can tell by the tickers. So the 4 or 3 letters are ticker symbols. So that's just shorthand for the name of the company. And so you probably see, like, what is your sense? What's your sense on what some of the biggest companies in the economy are? Feel free to just unmute yourself or you put it in the chat. What's your sense on who are the largest companies? Just based, again, on the size of the area. Yeah.
Apple.
I mean, yeah.
What else? Apple, probably Google, Amazon. A lot of tech companies.
A lot of tech companies. I think if you look at the S&P 500, I think about a quarter, that's probably close to 30% of the value of the 500 largest companies are tech companies. So they have done extremely well since March, since COVID, right? Because there's Amazon, people aren't going shopping as much. They're buying online, so they don't have to go to grocery stores. You have, Google, people are just spending more time online. So there's a company called Zoom, which is, what we're using right now. Zoom has been an incredible performer because they went from something like I want to say they had 20 million subscribers to like 300 million in like 2 months. Because everybody, if you all are in school, you're either, you're probably on Zoom if you're learning virtually. So when folks ask like, hey, what should I invest in? It's a boring investment, but you're not betting on an individual company, you're betting on the overall economy. Now, the cool thing is, historically, so if I look over almost any time frame, 30, 40, 50 years, the average return of what you see on that screen there is about 10%. Some years it's down 20%, other years it's up 30%, but if you just take the average, 10%. So there's this thing called the rule of 72, which says if you earn a 10% return, every 7 years, you're going to double your money. And so the advice I give all young people, you have something I don't have. You have youth. And there's, how many of you, raise your hand if you've heard about this thing called compounding returns? It's powerful. It's powerful. You guys have all the power because you probably have, 60, 70 years to compound. I probably only have about 30. And it is the sooner you can get started. So I like the idea of just getting started investing. And if someone said, hey, what's the first investment I should make? I think individual stocks get you interested in the market. So I don't tell folks never, ever invest in an individual stock because you know what, that might get you interested and excited. But what I always say is, if you're going to invest in individual stocks, also invest in index funds. Put 3/4 or more in an index fund. You own the stock market. It's not going to go up and down nearly as much as an individual stock. And then, take 20, 25% and buy individual stocks and see how you do. See what does better. Because for some folks, it's just, but you know what? If you're not interested in individual stocks, put it all in index funds. I'm talking about folks who are like, you know what? I want to make a bet. I think this company is going to do really well. So if you have an index fund, you can compare, hey, what did better than the other? But I think getting an early start investing is so important. So you feel confident that you can do it. The cool thing about buying index funds, folks, you don't have to be a stock market genius. Like, you don't have to pick which company is going to do better. You're betting on America. You're betting on the economy. You're betting on, so I think the sooner you can get experience, investing in the stock market, the better. All right. Yeah, how do you research index funds? Yeah, that's a great question. So I'm not a financial advisor, so I should get in trouble by giving you advice. I have had an account with Vanguard for 30 years. So Vanguard Investments. And you're probably not going to do wrong if you do Vanguard, Schwab, or Fidelity. Those are the big 3 in terms of index funds. but there's two words you want to look before you invest in an index fund. There's this thing called the expense ratio. That's basically the cost. So the tricky thing about investing is you never write a check to the investment management firm. You never write a check. They just take it right out of your account. So this thing called the expense ratio, and usually most or all mutual funds will have a fact sheet. So you're going to look at that fact sheet and you're going to say, what's the expense ratio for an index fund? Because an S&P 500 fund is an S&P 500 fund is an S&P 500. They're all the same. They own the same number of companies, and yet they will often have different fee structures. So expense ratios. The cool thing, one of the great things you guys benefit from is expense ratios usually tend to be very low. So I think with someone like Vanguard, it's like 0.04%. So every $100 you invest, you pay 4 cents every year. As your investment goes up, you'll pay a little bit more because it's just a percentage of your assets. And so, there's an S&P 500. If you want to be even more diversified, there's something called a total stock market fund. And that owns, as the name suggests, like 3,000 companies. So the S&P 500 is 500 of the largest companies. The total stock market means you're going to own small companies, you're going to own mid-sized companies, you're going to own really large. Now, both of these funds are only in the US. So they only invest in US-based companies, but many US-based companies sell their products overseas. So for simplicity's sake, if someone said, hey, what would be one fund just to get started? Because the cool thing is, by getting started, you're going to familiarize yourself. You're going to look at this. You're going to kind of want to understand more. And so I always tell people, don't feel like you have to do a ton of research. Just jump. You can now. The good news is many companies have made it a lot simpler, a lot lower cost. Like you can invest, I think on Robinhood, you can invest as little as $5. Like, so for me, it's more important you get started than feel like, oh my gosh, what if I make a mistake? Like, the cool thing now, I'm pretty sure on Robinhood, you could buy an index fund. Somebody tell me if I'm wrong here. You could buy an index fund for $5, $10. And so, because you don't know, the thing about the stock market, it goes up and it goes down, and you don't know how you're going to react. You don't know what the psychology, what's the noise you're going to hear in your head when you catch the headline, stock market drops 5%. Oh no, I better sell. And so you really don't know how you're going to behave until you put money into it. So I always tell people, tiptoe in, just get started and then continue to learn. Don't feel like you have to have all the answers. And yeah, so that's, there's a company called Ellevest, which is run by a Wall Street investor named Sally Krawcheck. And she has a great video out there. And she says there's a gender issue here. Women want to have all the answers. They want to do all the research. And as a result of doing that, they often don't take that first step. And so her admonition, her main message is get started and feel like you can learn. You can learn along the way. Again, start slowly. I think that's, day trading is a disaster. Yeah, somebody asked me a question about day trading. Day trading is a disaster because, again, you can go online. There'll be a ton of YouTube. Don't listen to old men like Mr. Ranzetta. This is the way you're going to make millions. Like, the only people who make money day trading are the people who are going to get you to spend $500 to learn their system. It just doesn't work. It can work for a while and then you get wiped out. Are there people who've made money? Yes. The percentages are really low. The percentages are stacked against you. Much better to have a buy and hold strategy. Many more people make money buying and holding. But again, it feeds into this desire to gamble. The best investing is not gambling. Like, if you ask me, hey, what do you think Tesla stock's going to do in the next week? That's gambling. If you ask me, hey, I want to make an investment in an index fund and hold it for 20 years, there's a very, 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 very high probability you're going to have more in 20 years than you do today. Tesla stock, I don't know what's going to happen next week. So I think if your time frame is really short, unfortunately, when you're young, that's the impulse. Like I want to get stronger faster, or I want to get richer faster. I'm sorry. Cool. There's some great conversation. You guys are asking some great questions here. Dividend stocks. So dividend stocks. So the way you make money investing in stocks is two ways. So you buy low and you sell at a higher price. Now you may decide you never want to sell, but you buy low and then the price goes up, and the difference. So you buy Apple stock at $200 and today it's $300. Then you've made $100 on paper, because you don't need to sell to make a profit. You could just look at your account statement and says, oh, I own one share of Apple. It's $300 today. I bought it for $200. That's $100. The second way you make money or income with stocks are things called dividends. So dividends are companies make profit, right? Companies have profits and they share some of those profits with investors. Now, dividends aren't so high these days. I think if you invest in an S&P 500 fund, let's say you invest $100, you might make $2, probably a little less. You might make $1.70 in dividends. So what that means is every quarter, every 3 months, you get 40 cents or 50 cents. So it's just cash that these investments throw off. But obviously it's not nearly as high as what you would see in real estate, when you're looking at cap rates. So dividends are kind of another way to get income. So dividend stocks, there are these mutual funds out there that if you have an interest in like, hey, I want to live on this income, then, I think dividend stocks tend to be more geared for retirees who are looking at their investments and saying, okay, I have Social Security, but I want to be able to take some of the income from my investments. So if you have a desire for income, then there are these mutual funds set up. Like I think there's one called Dividend Aristocrats, where they look at companies that have continuously increased their dividends. Then that might be a choice you make. It all depends on kind of what your needs are as an investor. Yeah, government bonds. Boy, you guys are good. Bryant, why don't you ask me more about this question?
So personally, I've done the stock market game twice for my financial lit class. The first year I started losing because it was the middle of the coronavirus and the stock market just plummeted. I invested in government bonds and ETFs because I heard that's what banks do, and I ended up being first. I was positive the only one. So I did it again, and I again took first. So I was just wondering how this correlates to real life, because I tried logging on to Robinhood, but it didn't let me. So I don't know. It works on the stock market game, but does it work in real life?
Yeah, that's a great question. So the stock market game, I'm going to give you my opinion here, and it's not a very popular one. I hate the stock market game because it gets you to focus on a very short-term period of time, and real life investing is like much longer term. So the reason you did well with government bonds is think of stocks and bonds as a seesaw. Oh, looks like my internet connection's unstable. Think of, let me turn the light on for a sec. Okay, so the reason Bryant won the stock market game, think of stocks and bonds as a seesaw. So when stocks go up, bonds often go down and then reverse. When stocks go down, bonds tend to do well. They're often called a safe haven. So what happened when the pandemic hit is the stock market dropped 34% in like 5 weeks. One of the fastest declines ever. Ouch. Yeah, it was really like people are like, this is bad, because the number one thing investors hate the most is uncertainty. Nobody had ever experienced a pandemic before. So investors like to sell first, ask questions later. Nobody knew how bad it was going to get. So stock market drops 34%. So then the Fed comes in and cuts interest rates. So the Federal Reserve kind of has to help the financial system because it's about to lock up again the same way it did in 2008, 2009. So the Fed comes in, lowers interest rates. When interest rates, so stocks drop, bonds went up. So what happened in a really short period of time is when interest rates drop, bonds do well. And so what happened was the same time the stock market dropped 34%, interest rates dropped 1%. Pretty big drop. So if you owned long-term government bonds, you might have earned 20%, in that period, that short period of time. Now, the problem with bonds now is the interest rate. So here's the federal government. Federal government issues debt. It's called Treasury Debt. The reason they issue debt is because the government runs deficits. I think we're going to run a $2 or $3 trillion deficit, or we just did in the fiscal year just ended. So the way the government funds the deficit is they issue debt, which is just IOUs. So I can lend money to the federal government, a 10-year bond, 10 years. So I'm going to give my money to the federal government, and they're going to pay me interest every year. And at the end of 10 years, they're going to give me my money back. Anybody want to guess? If I invest $100 in a 10-year bond, you guys can throw this in the chat, how much interest is the US government going to pay me? So I'm lending money to the government, $100. How much are they going to give me every year in interest? Put your guesses in the chat. So give it to me in dollars and cents rather than percents. So yeah, it's $100. So Ben is saying $3. Bryant is saying 0.6 cents. All right, any more guesses? Okay, I actually have to look this up because it recently changed. Here we go. Here is the answer. The 10-year Treasury bond is currently slow internet here, folks. Okay, so on 11/13, the 10-year. Okay, here we go. The answer, let's see who got closer. Looks like Joseph might be the closest. It is 89 cents. 89 cents. So if I looked at that historically, if I looked, say, over the last, some people go all the way back to like the Middle Ages with this analysis. That's really low. That's less than 1%. So the problem with bonds is you make money when interest rates drop. Interest rates are at 1%, less than 1%. So they can't drop much further. And the problem is when interest rates go up, so when the economy comes out of this pandemic, there is going to be a surge of demand like we haven't seen before, right? People are going to want to travel. People are going to want to eat at restaurants again. It's probably going to take a little while before that happens. But when that happens, the concern is that might start inflation. Bond prices, my personal opinion is you hit it right in terms of the timing of winning the stock market game, Brian, but over the long run, I'm not particularly bullish on bonds because they're not paying me a lot of interest today. And I know when interest rates go up, you're going to lose money. Because when interest rates go up, if you own a bond mutual fund, the value of that bond mutual fund goes down. So sorry, that was a long answer. But that's a little bit of history. It's kind of like when I was your age, the reason I was able to save so much for college, I was earning 15%. I had CDs, 15%. You go back to the 1980s, late 70s, early 80s, interest rates were really high. So basically I could put my money away when I was 15 and 5 years later it doubled. And it was not in the stock market, it was in a savings account. Yeah. Jabbar, that's a great question. But you guys are good. These are great questions. Dollar cost averaging. So those of you not familiar with dollar cost averaging, let's say you got a big gift. You got a graduation gift and you counted up all the checks from your relatives and it was $1,000 or $2,000. And you're like, I want to start investing, but I don't know if I should put all of the money in at once. So I'll give you two answers here. The academics would say 7 out of 10 years the stock market goes up. So the sooner you could take that lump sum and put it in the market, the odds are good because 7 out of 10 years the market's going to go up. That's the academic answer. The behavior or psychology answer is, boy, it would really suck if you put that $1,000 in the market and it dropped 10%. You would feel an amazing amount of regret because there's a psychological thing called loss aversion. When you lose money, that hurts about twice as much as the joy you have when you make money. So while the academics would say put the lump sum in, when I have had opportunities with lump sums, I dollar cost average in, which means you put money in over time. So you might decide, you know what, I'm going to take that $1,000 and I'm going to put some money in every month. I'm going to put 1/10 in over the next 10 months because I don't want to have to deal with the psychology of I put it all in at once and something happens. The pandemic, the vaccines don't work. Pandemic lasts longer. The market drops. So it's, you kind of have to know your own disposition. Does that help, Jabbar?
Hey, Tim, I'm gonna jump in real quick, just because we're kind of getting close to our time here. I'll say, Tim, if you're willing to stay on for a few extra minutes, that'd be great. If you need to run, Tim, then obviously we'll respect your time.
Sure. As long as you guys keep asking great questions.
But I'll say for the rest of you on the call, I know most of you plan on the meeting being done at a certain time, and you have dinner with your families and stuff. So if you need to go in the next 5 minutes or whenever, Tim and I will not take it personally. We understand that you have other plans and other things that you need to do. But if you want to stay on, absolutely stay on, and we'll have a few more questions with Tim. I think if you scroll up, Tim, you might find some other questions up there.
All right. Should you reinvest dividends? Yes, I would say yes. So what reinvesting dividends mean is, as you earn these dividends, you can either take them out. I guess it depends. It depends. I'm sorry, is it Catalina? Did I get the pronunciation right?
Yeah.
So it depends. If you need the income. So again, what happens is the dividends get paid in cash, and you can decide to either take that cash. Let's say, that would help me pay for books. So that's going to help me. I need the cash. If you don't need the cash, then it just allows you to reinvest that money and buy more stock. So if you don't need it, reinvesting dividends is probably the way to go. Because you'll continue to grow the number of shares that you own. Yes, side hustles for a 15-year-old. That's a great question. Yeah, I don't know. I think it's one of the. I got my start with a newspaper route, and I know kids don't get newspaper routes anymore. I think that was the most valuable experience I ever had because I had to work 6 days a week, and I had 50 people who were relying on me to drop a newspaper off, and I made $25 a week, and I saved it. It started me down this road of saving for college. It was so valuable. So I don't know. I would ask folks, what you're currently doing for side hustles. Because it's challenging. I know. I think when do you get your working papers? Is it 14 or 16? When are most of you? Let's say you wanted to go work at a Starbucks or what's the?
I think it depends on the state because I'm from California too. So I think at California, I think you can be 16 or even 15. It's one of those
Most
two.
places won't hire you if you're under 16, but I believe there's places where you're allowed to. Most companies won't do that anyways. At least around where I am.
So it looks like Brian is detailing vehicles. What do I hear? People tutoring. Like, let's say you're really good at math. There's always people looking for math tutors. Yeah, I think part of it is figuring out what you enjoy doing and then seeing, is there a business that I can, there's a website called Nextdoor, which is kind of a neighborhood thing. Like, is there something some service you could provide to neighborhood kids running as when the summer rolls around, if people still are socially distancing, is there something that you enjoy doing that you could share with students via Zoom? I think it's being creative. You have Etsy. I just had a bunch of teachers on my my podcast recently. Somebody loved knitting, and so they had an Etsy store and they knit holiday stockings. So I think part of it is just thinking about the skills and talents you have that you enjoy doing. DoorDash. Yep. Yeah, DoorDash may go public. Actually, I think they filed to go public. So when a company goes public, that means they're going from private ownership to public ownership. And DoorDash clearly has been benefiting from the pandemic. So, yeah, it's trying to be creative. And again, doing your own little brainstorm on a sheet of paper. What are all the skills and talents that you have, and trying to figure out, okay, how can I bring that to people in a way that I can earn money. Yeah, this is like Ben's question. This is you guys are lucky to have these opportunities. And I think another teacher that I had on recently basically bought things on eBay and then resold them. So looked for things that she thought were undervalued and then went and sold them. And so the cool thing for you guys now, for those of you who have business ideas, is the cost of starting a business has never been lower, because you don't need to go, if you have a tech business, you don't need to go buy a bunch of servers. You just go on Amazon Web Services. So I think it comes down to, without getting into details, Ben, it's kind of trying to figure out, how your product or whatever you're selling is going to stand out on Shopify. And it's the same for, social media marketing. It's crowded out there, right? Everybody's trying to be an influencer. It's really, so I always think, when starting a business, start small, with friends, with classmates, to see if there's something there before you invest kind of a ton of time. There's a question about Roth IRAs. Yeah, so that's a great question. I don't know if Catalina is still here. So just what a Roth IRA is, it's a type of investment. It's not. It's a type of account. So when you put money into a Roth IRA, you are starting to save for retirement. And the cool thing is, with many retirement accounts, they have all these strict rules. You can't touch the money. But with Roth IRAs, they're a little bit different, in that they're more flexible. So they give you that level of flexibility where I believe you can actually take out, let's say you put in $2,000 and over 5 years it grows to $4,000. You could take out that $2,000 you put in without incurring any taxes. And so when folks, is that advice you give, Dan, when a student says, hey, what do you think about Roth IRAs? That it's a good wrapper, it's a good type of account to put your, the initial amount of money that you're going to invest in.
Yeah, I don't know that this group's ever asked me about Roth IRAs, but my take on it would be that they can be good, but I don't like the idea of putting money into a Roth IRA thinking that, oh, if I ever need my principal back out, I'll do that. I think it's better if you're putting money into a retirement account that you're not going to touch it, principal or interest, until you're actually, let's say, retired. In an emergency, if you needed to tap into your principal and take your contributions out, fine, but I don't think that should be part of the plan. Another thing that's interesting, Tim, with this group, they all do, I think, with the real estate investing also comes the idea of reaching financial independence early in life. So being able to retire earlier than 65, not that they maybe would or wouldn't, but at least the numbers, the passive income allows them to retire. And what I tell some people about that is that when you put money into a retirement account, it's 59 and a half or 65 that money becomes available to you. And if you're reaching financial independence at 50, 40, 30, then those don't make as much sense. They're not bad places to put money, but you just know that you need to know that you're not going to be looking at that money again until maybe you're well past your actual retirement date. But that gets into some other ideas that maybe we don't really need to talk about right now. But I think Roth IRAs,
you're exactly right.
Roth IRAs are there's not much wrong with Roth IRAs. Yeah.
Yeah, if you guys are into the FIRE movement, you should come Thursday at it's Thursday 1 p.m. Pacific time. I'm bringing there's going to be, my guest is going to be a guy named J.L. Collins. He wrote a book called The Simple Path to Wealth. And this is like a session that I'm doing. It's primarily going to be teachers there, but let me give you a link if any of you are interested. He's kind of generally considered a leader in the FIRE movement. And I like, as the name of his book suggests, it doesn't need to be complicated. Again, he won't be talking as much about real estate, but he will be talking about, if you're interested in investing, he will be talking about that. Let me give you a link. And I'm going to be giving books to 100 people who attend. So if you attend, I will make sure you're one of those 100 to get the book, because I think it's a really good book. He's kind of like the wise uncle we all wish we had, is the way I would describe JL. Here, let me give you a link to register. Or actually, no, better yet, let me just give you the Zoom. I'll just give you the Zoom link.
I'm going to guess, Tim, that most of the young people on this call at least have heard of J.L. Collins, if not maybe even heard some podcasts. He's everywhere in the FIRE movement. And these young people, they listen to a ton of podcasts, read a ton of books, a lot of blog articles. I'm sure they've come across this name, or if not, because you're right, he is kind of the wise uncle of the FIRE movement, and he's really well known in that circle of people. So this is great that you're giving them the opportunity.
Yeah, and again, if you guys attend, you just need to make sure I know that you're there so I can get you a copy of that book. Because, we're going to have, my guess is he's a pretty popular guy. We're going to have a couple hundred people, but if you guys attend, I will make sure that you're one of the 100 that get a book. So I just put the Zoom link in the chat. And again, that's 1 p.m. Pacific time, Thursday. And I might even shout you guys out if I see you there. Put in the chat. If you're there, put in the chat. Just say, Tim, we talked on Sunday.
They might just say,
cool.
They're a Sheeks freak. That's kind of our group name here. The Sheeks Freak Mastermind. So if you see that, then you'll know them.
Cool.
Thanks, Tim.
Yeah.
Well, maybe take one more question if someone wants to put one in the chat. Otherwise, we'll respect Tim's time, because it's in California, it's not too late, but we have some on the East Coast where it's getting a little bit later.
Actually, Tim, where are you at? Because I'm in San Francisco. I'm actually in Pacifica.
Okay, I'm in Pescadero right now, but I spend most of my time in Palo Alto.
Oh,
Yeah.
Okay. Okay, cool.
Well, maybe we'll call that a wrap. Tim, would you mind, or I don't want to offer this up, but if you put your email address in the chat?
Yeah.
Or if they had a question that they think of tomorrow or something, they could shoot you an email.
Yep.
Thank you for doing that.
I didn't actually talk about, let me give you a minute about what I'm doing now. So 10 years ago, I taught a personal finance class, a summer school class. So had no experience teaching, but there's a great school in East Palo Alto, a great high school called Eastside Prep, serving first gen kids. So kids who were going to be first in their family. So that resonated with me, having been somebody who didn't have parents who went to college. And I looked for curriculum and I didn't see anything that I was excited to teach. So I went ahead and created my own. And that experience in the classroom, seeing, these are ninth graders, and just seeing how excited kids were to talk about money in a way that was engaging. And then I started getting emails from parents saying, you know, David came home talking about investing for retirement. I have not invested yet. Can you help me? I was like, holy cow, like this is, you can really have an impact if you're serious about this. So 6 years ago, I got serious about it and I started a nonprofit called Next Gen Personal Finance with a goal of ensuring that every kid before they cross that graduation stage has at minimum a 1 semester personal finance class. It's such a no-brainer. Like how can we let kids leave high school having taken algebra but have never learning about money? Like it's something you're all gonna have to deal with. And it would be great if everybody's parents talked about it, but we also know it's a difficult topic to talk about in a household. It's the way it is. And so if we want to reach all kids, we got to do it in school. So that's kind of what my life mission now is, like 1 out of 5 kids. Raise your hand if you've taken a 1 semester personal finance class. Okay. It's got to be only a personal finance class. So I'm not talking economics. It's got to be just personal finance. Okay. No. Okay. Okay. So wait a minute. JD, where'd you go to high school?
Well, it's a smaller school. There's only like 100 kids in my grade.
Texas.
Public or private?
It's a charter school over in the Phoenix area.
Oh, Arizona, sorry.
Yeah.
Okay. Very unusual. So here are the numbers. Bryant, where'd you go?
San Juan High, it's a public school. But I
What
took
state?
it with the college. San Juan High, Utah, Southeast.
Yeah, so Utah is one of 5 states that require every kid graduating from high school in Utah. It's only 5 states, only 1 out of 5 kids nationwide. So 20% of kids graduate having taken a personal finance. That's a crime. Like that is criminal. And the cool thing is like we have a free curriculum and we train teachers. And so our mission is that in 10 years, 2030, we call it Mission 2030. By 2030, every kid will have taken a personal finance class. And so that's what drives me today. So, you know, there's 15 of us on our team and we just love what we do. And we love working with teachers. You know, the way we work is, you know, we have curriculum. So if you go to our website, ngpf.org, you know, we've got games on there. It's called the Arcade. But then we also have serious, you know, we have lessons on pretty much every topic you can imagine under the sun. We want this course to be fun because it should be. And the reason I started the organization was I felt like the way it was being taught was it was way too academic. This should be a game this should be a course where you have fun, where you do research, you go out and learn how to use the web, you figure out what are reliable sources of information, you plan a budget after you graduate from high school or college, you learn about index funds through a game we created called Stacks. So we just have a lot of fun because, again, this is so important, and I think we're going to be so much better off as a nation if we just ensure that kids get this before they go off into the real world, whether that means college or anything after high school. So,
and Tim, that's where you and I are just boom. We're I also think it's borderline criminal that our young people can leave the doors of their high school out into the real world and not know anything about money. I love teaching kids and mentoring kids about real estate investing, and I think all of you on this call know this, real estate investing doesn't happen without some good, solid personal finance foundations, building credit scores, side hustles, using credit cards intelligently, knowing how money works, basically. which I think most of you have the basics down, and if you don't, there's still time, but there's I love the saying that, and I'll mess it up, but something like, if you can't manage $1,000, you can't manage $100,000. So basically something like that. Like if you can't manage your money right now, no matter where you're at with a low income, then making more money is not going to solve your problem. You're just going to mismanage more money and you're going to be still broke, is what that means. So Tim, I want to thank you for your time tonight. We'll let you get back to your family.
No, thank you guys.
Hi everyone, if you like this video and want to see more like it, make sure you give this video a thumbs up and subscribe to our YouTube channel. You should also go check out our website and Instagram, which are both linked below this video. Thanks again for watching. Now go and get your freak on.